Understanding mergers, types, processes, and real-world examples. Mergers are a prominent feature in the landscape of corporate strategy. Defined as an agreement that unites two existing companies into one new entity, mergers can significantly affect market dynamics and shareholder value. This article delves into the various types of mergers, how they operate, their benefits, and notable examples that illustrate their impact. What is a merger? A merger refers to the voluntary fusion of two firms into a single new organization, usually defined as occurring on broadly equal terms. This should not be confused with acquisitions, which typically involve one company buying another outright, often resulting in a dominant player absorbing a smaller firm. Mergers aim to leverage synergies to enhance shareholder value and market presence while often including a no-shop clause to prevent competing bids during negotiations. Key takeaways. Definition: mergers combine two companies into a single entity, often aimed at enhancing value for shareholders. Purpose: companies often merge to expand operations, access new markets, and increase revenues. Varieties: there are 5 major types of mergers: conglomerate, congeneric, product extension, market extension, horizontal, and vertical. How a merger works. In a merger, both companies involved are usually of similar size and stature, often referred to as a merger of equals. The merger process involves negotiations and due diligence, leading to an agreement that details how shares of the newly formed entity will be distributed among the existing shareholders of the merging firms. Post-merger, the new company aims to harness combined resources and capabilities to optimize operations, reduce costs, and amplify revenue streams. The ultimate goal is to increase shareholders' value, which is often realized through higher stock prices and dividends. Current market landscape. The backdrop for mergers and acquisitions has seen significant changes recently. For instance, in 2023, the total value of U.S. mergers and acquisitions decreased to $1.33 trillion, down from $1.49 trillion in 2022, hinting at a cautious approach by companies amid economic uncertainties. Types of mergers. Understanding the distinct types of mergers is crucial for assessing their implications for the companies involved and the broader market. 1. Conglomerate merger. This merger involves two firms operating in unrelated industries. It can be pure, where no synergy exists, or mixed, where firms seek to enter new markets or acquire new product lines. For example, Disney's acquisition of ABC in 1995 represents a conglomerate merger. 2. Congeneric, product extension, merger. This merger occurs between companies in the same industry with similar product lines. By merging, these companies broaden their offerings and market reach. An example would be the merger of Citigroup and Travelers Insurance in 1998. 3. Market extension merger. This type merges firms selling the same products but competing in different markets, thereby expanding their market base. The merger of Eagle Bankshares and RBC Centura in 2002 serves as a typical case. 4. Horizontal merger. This merger occurs between competitors in the same industry. The aim is to consolidate market power, achieve economies of scale, and reduce competitiveness. A prominent example is the 1998 union of Daimler-Benz and Chrysler. 5. Vertical merger. In a vertical merger, companies at different levels of production within the supply chain combine. This merger can streamline operations and enhance cost efficiency. A well-known instance was the AOL and Time Warner merger in 2000. Notable examples of mergers. Anheuser-Busch InBev. This company epitomizes how mergers can create vast conglomerates. Formed from the combination of several large international beverage firms, including Interbrew, Ambev, and Anheuser-Busch, Anheuser-Busch InBev exemplifies both horizontal and market extension mergers, enhancing its reach in the global beer market. Vodafone and Monisman. The 2000 merger, valued at $190 billion, is historic for creating the world's largest mobile telecommunications company. This transaction is one of the largest in history, highlighting the expansive reach such mergers can create. AOL and Time Warner. Despite its initial promise, the $164 billion merger is often cited as one of the biggest business failures due to cultural clashes and contrasting business strategies. This served as a learning lesson for many future mergers. Understanding special mergers. SPAC mergers, involving special-purpose acquisition companies. These mergers allow private companies to go public by merging with a listed SPAC, typically designed to raise capital for acquisitions. Reverse mergers, a method where a private company acquires a publicly traded company to bypass the lengthy process of going public, often seen as a quicker route to gain visibility and access to capital markets. Conclusion. Mergers represent a strategic avenue for companies aiming to grow, consolidate, and enhance their market presence. While they harbor the potential for great success by increasing market shares and reducing costs, they also come with risks that must be carefully managed. As market conditions evolve, the landscape of mergers and acquisitions will continue to shift, prompting businesses to adapt their strategies accordingly. Understanding the types of mergers and their implications is essential for stakeholders navigating this complex terrain.